Hey everyone, welcome back. Let's quickly go through today's market using three key charts. We'll start with the 10-year Treasury yield, then move to QQQ, and finish with the broader market via SPY. Today's session was all about rates pressure and weak follow-through in equities. Let's break it down step by step.
On the first chart, we're looking at the 10-year Treasury yield. Today, TNX is trading around the 4.2 to 4.3% area with a relatively modest daily change. But the structure is what matters here. We saw an attempt to push higher earlier in the session, followed by selling in yields, and then stabilization, not a breakdown. This tells us that bonds found some demand, but there was no aggressive flight to safety. Yields remain elevated, and that continues to act as a headwind for risk assets. So, even though yields didn't spike today, they also didn't fall enough to give equities real relief. That context is critical when we look at tech.
Now let's move to QQQ, and this is where weakness is most visible. QQQ sold off early in the session with strong downside momentum in the first half of the day. We then saw a bounce attempt, but it was clearly corrective, not impulsive. Key points on this chart. Sellers controlled the early move. Buyers stepped in late, but price failed to reclaim key intraday levels. This is classic distribution behavior, not accumulation. Even with yields stabilizing, tech could not attract strong buyers. That tells us positioning remains defensive, and traders are still reducing exposure rather than adding risk. Now, let's look at SPY, the broader market. SPY held up better than QQQ, but the message is similar. We saw early selling, a push lower, and then a bounce that lost momentum quickly. The market is not collapsing, but it's also not trending higher. This is a market in wait-and-see mode. SPY's relative strength compared to QQQ suggests a rotation away from growth and into more defensive positioning. Still, the lack of follow-through on the bounce shows that buyers are not confident yet. Putting all three charts together, today's picture is clear. Yields remain high and stable, not supportive. Tech is underperforming. The broader market is holding, but without strength. This is not a bullish confirmation day. It's a market that's pausing, digesting, and reacting to rates rather than leading. As long as the 10-year yield stays near current levels, equities, especially tech, will likely remain choppy. Expect fast intraday moves, limited follow-through, and continued sensitivity to any rates-related news. That's it for today's market update. If you're trading short-term, stay flexible. If you're positioned longer-term, patience is still key here. Thanks for watching, and I'll see you in the next update.